Let's take a look at our projected forecasts for housing and mortgage rates for 2023. Housing is vital to all of us, and we've seen home prices come down just a little bit after soaring high. So what does 2023 have in store? As we know, with everything else, supply and demand will play a role, and impacting demand will be where interest rates are. As interest rates rose in the fall of 2022 and in early winter of 22, we saw demand really slow down. But interest rates have at the end of 22 started to show some signs of improvement, meaningful improvement. Now, we think that's going to continue into 2023, and we want to show you why. As we mentioned frequently, interest rates, mortgage rates, any long-term rate is going to be driven by inflation because inflation erodes the buying power to the recipient of that fixed payment they're receiving on long-term bonds like mortgages. So the recipient of these monthly payments will see that value, the buying power, erode faster if inflation is higher. So they only have one type of defense, and that's to charge a higher interest rate. But as inflation comes down, mortgage rates come down. So let's take a look at this. We've got some slides to share with you from longtime mortgage expert and crystal ball winner Barry Habib from MBS Highway. And what Barry's going to talk about first is how mortgage rates take their lead from inflation.
I think here that's inflation. Here's mortgage rates. And you can see historically, inflation rises, mortgage rates rise, inflation softens, mortgage rates soften. And inflation goes flat, mortgage rates go flat. Here you got a little spike in inflation, boom, mortgage rates respond too. Now, we had a period here that the Fed, although their interest rate moves don't directly affect mortgage rates, when they go in and buy mortgage-backed securities, well, that's going to have an impact. And that was quantitative easing, or QE. And during their period of QE, they kept mortgage rates right around 3% here. And you can see that. But as inflation started to rise from very low levels, near 1%, started to rise, the Fed did think it was transitory. But mortgage rates didn't respond like they normally do. Why? Because the Fed kind of put a hold on it. The Fed was just buying enough mortgage bonds to tie them to that 3% rate. Now, once the Fed understood that inflation was not transitory and they were kind of behind things, mortgage rates started to move higher once the Fed stopped buying. Mortgage rates did what they always do. They follow inflation. So as inflation rose, mortgage rates rose. When inflation took a little bit of a reprieve, so did mortgage rates. They moved lower with inflation. Then inflation started to move up, and sure enough, mortgage rates did as well. And as we've seen inflation come down at the end of 2022, mortgage rates have made some meaningful improvement, although they are significantly higher than where they were. So when we take a look at measuring inflation, we're going to look right now at the Consumer Price Index. There's a couple of different measurements. There's the Personal Consumption Expenditures, the PCE, and then there's the CPI. Now, the CPI data may actually be more realistic for what's happening in inflation, but in addition to that, we get this data earlier, so it's a better measurement of forecasting. Now, when we take a look at the most recent numbers ending 2022, inflation on the core, which takes out food and energy, that could be affected by things like oil production from OPEC or weather conditions. So monetary policy is not going to be able to influence those things. So the core rate is something that monetary policy can have an influence over. The rate of inflation on the core CPI closing out 2022 was at 6% on a year-over-year basis. So when we take a look at the most recent data that we received, we only got it through November. We'll get the December reading the second week in January of 2022. So if we take a look at each month's individual reading of inflation for the 12 most recent months, that's how you get to 6%. There's a little rounding and compounding there. So as we take a look moving forward, what we are going to start to do is replacing these numbers here. You can see December of 2021 will be replaced with new numbers for 2022. You can see the more recent data is showing reduced inflationary pressures. We know the economy is slowing. We know that we're headed for a recession. And we also understand that shelter costs, which play such an important role, and I'll talk about that, are also coming down. So this should all mean that we'll see lower monthly inflation readings replacing higher inflation readings that will now be taken out of the equation. So as we get December of 2022 replacing December of 2021, should be a lower number, and that should bring year-over-year inflation down. We should see the same thing in January, February, maybe not so much in March, but certainly April, May, and June, which is why we are thinking that inflation makes very meaningful improvements in the first half of 2023, as we get rid of these high readings and replace them with the lower readings. So we replace 2022's higher readings with lower 2023 readings that'll be ahead of us. That should help mortgage rates decline. Now, one of the big things that we're seeing is shelter costs coming down, and coming down rather significantly. So when we take a look at where it was here near 18% and now closer to 4.5% or so, we expect this to continue to come down. It's still going up at these levels, but it's putting a lot less pressure on. However, the way that it's calculated in the CPI numbers, and remember, about 39% of core CPI, it's actually 39.3%, are shelter costs. It averages the past year. So when you do that, you're actually getting upside inflationary pressure, because what this is taking into consideration is live real time here, this 4.6. But you could see here that the 7.9% and this move up is averaging for the past year, because things like leases, they don't turn over all at once. It takes time for those new leases to reflect what's happening. So you're kind of locked in paying those old payments. So this really has a big lag effect. But while this is kind of adding some buoyancy to the current level of CPI, because it weighs in, as I said, 39.3%, when we go forward and this eventually catches up and rolls over just like this does, you got to remember this lag effect. So you see this started to go up quickly, and then this is following suit more slowly. Now, as this slows down and comes down, this will eventually roll over in the not too distant future. It's kind of like a roller coaster. You know, if you recall going on a roller coaster, there is that point in time when that first big hill that it goes over, a part of that roller coaster is heading lower, but there's still the back of the roller coaster that still has to go higher. And that's kind of like where we are. Real shelter costs, as I showed you before, are heading lower. But the way it's measured in CPI, you remember that blue line going up, it's showing that shelter costs are going up because of the lag effect. As we get past January, all of these will start to come down, and that should help inflation from the shelter component come down more rapidly, and overall inflation should get a boost from this. This is another benefit why we think inflation comes down the first half of the year, helping mortgage rates to come down. Now, all segments have been lower except shelter. Prices have come down across the board for things like food, gas, clothing, and all those are reflected in CPI. But shelter, which again, 39.3% of it, it's decelerating, but it's still showing those increases in CPI due to that lag effect. Now, one other thing to take very important note of is the relationship between the US 10-year Treasury, and that's illustrated in blue, and 30-year fixed rate mortgages illustrated in yellow. Now, this compresses 35 years in one single chart. You can clearly see there's kind of a relationship between the two. It's not day to day and it's not exact, but there's kind of a range that this gravitates towards, and it's about 175 to 200 basis points. Put in other words, 1.75% to 2%. So in the past, if the 10-year Treasury were, let's say, somewhere in the range of 4, then mortgage rates should be somewhere in the range of 6. If the 10-year Treasury was at 5, mortgage rates would be somewhere in the range of 7. This has been going on relatively consistently for 35 years until what we had seen towards the end of 2022, when the difference between the two of them was not 175 to 200 basis points, but 300 basis points. That's an enormous change in the spread. So it was 3% higher. When you saw the 10-year Treasury a little over 4%, mortgage rates were a little over 7%. So why did we have that? The normal range is, let's call it 2%, now went to 3%. Why? What happened that changed over the past 35 years? Well, you have to remember that part of the value that goes into a mortgage, and remember, more value equals lower rate. As a bond's price goes up, the yield goes down. So helping the bond price of mortgage-backed securities go up is something called servicing. See, no one holds a mortgage on fixed rates. If you're making your payment to a company, you might think they're holding that mortgage, but they're not. That mortgage is sold in the secondary market. But what has to happen is someone still has to maintain the duties of collecting payments, of telling you if you're late, answering your questions, taking that payment and making sure the taxes and the insurance are paid. They have to service the mortgage, and they're called a servicer. Now, for doing that, for performing these tasks, they receive a fee. So that adds value to the mortgage. And you could calculate a good estimate of that fee based upon how long you expect those fees to be out there. Now, under normal conditions, mortgages can last for years, several years, right? 4, 5, 6, 7 years for a mortgage. So you're going to collect that servicing fee for a long time. So that's a lot of value that's contained within the mortgage. And that added value helps the mortgage bond price, which helps to bring the rate down. But now, when rates hit above 7%, everyone was thinking that these rates would not last and they would come down. The smart money was agreeing with us. They thought inflation would come down, which would bring rates down. And as mortgage rates anticipated to drop, that means that the servicing would not last because people would refinance or pay off their mortgages. They aren't going to keep those 7% mortgages for a long time. And because of this, it sucked out all the servicing value. That servicing value wasn't measured in years of a revenue stream, but in months, making that revenue stream much smaller, the value much less, and the component that went into the bond's price much lower, which meant the rates were moving higher in relation to the 10-year. Now, as the 10-year drops, as we have forecasted, and it goes lower and lower and lower, not only will mortgage rates drop, but they will drop faster as more servicing value gets added in, because let's face it, a 6% mortgage will be on the books longer than a 7, so that's more servicing value. A 5% mortgage, more than a 6, more servicing value. So it will accelerate its decline in a more rapid fashion than the 10-year Treasury will. And we've already started to see that. As we closed out 2022, that spread was narrowing at the end of 2022. As the 10-year Treasury moved closer to that 3.5, 3 5/8 rate, mortgage rates already started to move into the low 6s. So that spread, which was about 300 basis points, already narrowed to something closer to about 270 or 260 basis points. So we're seeing that happen already. Now, we do think that 10-year Treasury gets around 3 or even less because of lower inflation, which means mortgage rates should follow suit. And if we do get that 3% rates, we should start to get some more normal servicing values. And that means that we're seeing mortgage rates closer to 5% around the first part of 2023. Now, there is a recession coming. And why has this been staved off, if it has been staved off? The problem with knowing when you're in a recession is you get the National Bureau of Economic Research to declare you've been in a recession, but they don't typically do it till a year after you were in it. You're typically in and out of it before they tell you where you were. Doesn't really do you a lot of help. But what you can see here is that there's already signs. Take a look at credit card debt. We are, after stimulus, living on credit cards for many people and also tapping into savings. These bumps here are the 3 stimulus packages that help people with savings, but that's been all drained out, and we're even moving much lower than pre-COVID levels. So people are keeping the lifestyle, but they're using credit cards and savings to maintain it. Even this has an expiration date and limitations on it. And when that hits a brick wall, the recession will become evident. Now, we know that there are also things that are proving to be important signs like yield curve inversions. This is when you take longer maturities that are supposed to have a higher rate of interest that actually yield a lower rate of interest than their shorter term counterparts. And a very reliable indicator is when you take the US 10-year Treasury and you subtract the 3-month Treasury. Now, the 10-year is supposed to be higher than the 3-month, so a bigger number minus a smaller number, it should be positive. But the yield on the 3-month Treasury is actually higher than the 10-year. So when you take the 10-year minus the 3-month, you're getting a negative number. And when that happens, which here's the zero line, negative, recession, negative, recession, negative, recession, negative, recession. And we are very negative here. So we are either right on the cusp or in or about to head into a recession. You can even see the last one here. It was awfully close before the recession. So this is a very reliable indicator of recessions. And during recessions, mortgage rates decline. Now let's shift our focus to housing. And one of the most important aspects of housing is the supply and demand component. Now, the demand will come from household formations. And we have been chugging along at forming households at a rate of about 1.7 million a year. And this is where you have a family member who's living in at home, let's say it's one of the children, comes of age and they move out and they get their own place. So it's still the same family unit, but now they're occupying an additional household. That's a household formation. We've been chugging along roughly 1.7 million for a while, but as we saw mortgage rates get to over 7%, some of those people that were going to form households went into a bit of hibernation, waiting for rates to come down. So this is kind of pent up demand here. And now at the same time, supply is softer. Builders have slowed things down. They're completing about 1.5 million homes, but yet there's about 100,000 homes every year that have to be replaced because of aging. So we're only seeing about 1.4 million homes come on the market. And currently, with that hibernation, about 1.3 million household formations. So that's why the housing market has slowed for now in activity. But when rates come back down, you're going to have household formations go back to its normal rate of about 1.7 million, and that'll overwhelm the supply. That should be very supportive of prices. And builders, they've slowed things down. Permits have slowed. They learned their lesson from that housing crash in 2006 to 2009. While people want to say it's a housing crash, hardly the case. Look, in the last 10 years, prices are up 115%. In the last couple of years, they're up 39%. Now, even with rates at 7%, we've seen them come in a little bit, down about 2.5%, but not very much, even with the headwinds of much higher rates. And the reason for that is because inventory is still very light and competing rents are still pretty high. People want to buy homes. They're just hibernating for a bit. But remember, when rates come down, things will change. And another aspect that plays into all of this is affordability. And I think affordability really needs to be explained. Because when you do the math on this, it paints a very different picture than what the media is telling us. So let's assume last year you needed to buy a home and take out a mortgage of $400,000 to buy that home. So you're buying a home, your mortgage amount was $400,000, and last year you get a rate around 3.5%, so here's your payment. Now things have changed this year, haven't they? So as we bring this to you at the end of 2022, we're about to enter 2023, home values in the past year have gone up about 10%, which means to buy a similar type home this year compared to last year, you'd have to spend 10% more or take out a mortgage 10% higher. That means you need to take out a mortgage of $440,000. And today's rates as we enter 2023 are closer to about 6.25%. So that makes the affordability gap here quite large, $900 a month. The problem with just looking at it this way is it only tells half the story. And the media won't tell you this, but look, a year ago, if you purchased this home, and Fannie Mae gives you good data on this, and they will tell you that not the qualifying income, but the average income of a household buying this home was about $9,000 a month. So imagine two people making about $50,000 a year or so. That's what you're looking at here. But now the ADP, the payroll company, they measured 25 million records. And in their 25 million records, they tell us that if you stayed at your job, your income went up 7.6%. If you switched jobs, it went up 15%. So more people obviously stayed than switched. So if you took an average and weighted it, it's about 9% increase in incomes, which really mitigates a lot of the problem here. So this is not the main problem, but what's also happened at the same time starts to add up because we're paying more for gas and food and services. So you know why the market's softer now, and why it's slower, and why people are hibernating is because their payments have gone up so much. And while their income's gone up, it's not enough to cover this. So people are taking it a little slower. But what we have to start to do is think forward. So let's start to think ahead to next year. Now, next year, what's going to happen to these incomes? Well, they're going up at 7.6% now, but let's be a little more conservative and say they only go up at 5%. Well, if they do that, then your income will have gone up next year, from $9,000 last year to $9,800 this year to $10,300 next year. That means you're making $1,300 more based upon this increase than you were last year, but your payment's gone up $1,100 a month more. So you pretty much mitigated all of the negativity of the market change. Now, if we're right, and indeed inflation, as it's showing very strong convincing signs of, go down, even couple that with a recession to drive rates down further, it would certainly be understandable to see that relationship between the 10-year and mortgage-backed securities move closer to a 5% mortgage rate. That means that you now literally make 2023's affordability better than 2021's. And you still have tight inventory, folks. So our housing forecast shows low single-digit appreciation for most of the U.S. with a pickup in activity. And the reason for that is because of lower inflation. You've got recession-like slowdown. You've got incomes increasing to help affordability, as we just showed, and very tight inventory environment. Rents are still expensive and rising, not giving people much of an alternative. So we see appreciation for most of the U.S. and an increase in activity. Now, our mortgage rate forecast, well, let's look at some of the headwinds. There's global quantitative tightening, so money's getting tighter. There's lack of foreign central bank buying. We know that, so these can be headwinds. And look, there is a lot of debt out there that's got to be financed too. Our tailwinds are lower inflation. Inventory is building to record levels, and that means there will be sales driving down prices. Mortgage servicing value has increased, and there is likely going to be a recession where rates decline. We see 30-year fixed rate mortgage rates move near 5% during the first half of 2023, and the 10-year treasury near 3% or lower. We actually believe that will go lower. So we think there's good news ahead. We believe that there's reason for optimism as we look to 2023, and we wish you all of the best. We wish you health, happiness, and prosperity in the year ahead. Thank you.